We've been speaking with Hugh Young, Managing Director of Aberdeen Asset Management Asia, a long-time India watcher and, of course, a veteran investor himself. Hugh, financials. Your two investments have been HDFC and Kotak Mahindra Bank, and they've served you well. But would you now cast your net wider on the NBFC space, as we call it, the non-bank finance companies?
Yes, we've preferred to concentrate on those two names. We also, by the way, have HDFC Bank and ICICI itself as well, which I think at the moment suits us quite nicely. Of course, HDFC and Kotak have done exceptionally well, and in all honesty, it's hard to argue that they're desperately cheap investments, but in finance in particular, we're far happier to concentrate on quality first and strength of balance sheet and loan approval processes, all those sorts of things, rather than just on price, because if you build a poor quality business in a highly geared financial organisation, that can be absolutely disastrous. So I see us sticking with both HDFC and Kotak as our core holdings.
Okay. Not any of the other non-bank finance companies?
Not that we've seen as yet. We always look. We're always keen on new things, of course, in portfolios, but we also like to stick with those who've served us well in the past, of course in the expectation that they will continue to serve us well in future, and both HDFC and Kotak have certainly so far proved that to be the case, but we're always on the lookout.
Okay. Well, from the auto space, two stocks that you still have in your portfolio are Bosch and Hero MotoCorp. They've been great wealth creators in the past, but in the last 2 years, these stocks have been absolutely flat. They've not given any returns. Why do you think that is? And has the time come to sort of churn in this space?
Well, Bosch continues to be an incredibly strong business. One of the issues with Bosch has, of course, been its valuation. Which doesn't leave much scope for huge appreciation in the way it's valued, because it's already at a premium valuation. The underlying business is still quite a strong business. Hero, there's always been the doubt since the split with Honda over what its business would be like, but it's still, I think, continue to do better than our expectations. We really did worry at the initial stages of what effect the Honda split would have, and it still fared quite well as a fundamental business. But it does have a major market share. There are lots of competitors out there trying to eat its lunch. And I'm afraid that's true of every business in which we invest. There are always people sort of chasing them down and trying to do things better and cheaper.
Okay. What about Indian healthcare stocks, Hugh? Because, that is again a space where we have seen some problems, especially those exposed to the US.
Yes, certainly anything to do with generics and the US can be an issue, and India is one of the world's leaders in that field. So it's not without its problems. We do have exposure to farmers in a variety of companies, from the Suns and Lupins that we own in our portfolio, and some of the more domestically focused companies such as Glaxo and Sanofi.
Hugh, a couple of more questions on actually Indian macros. As an important representative of the foreign investing community, how have you actually looked at this demonetisation itself? Is it a reaffirmation of reform? Is it just a near-term confusion? Or is it a slightly longer-term harm for the Indian consumption story?
Well, I certainly think it's the first two. Yes, there is certainly confusion, and there's a bit of a hiccup as a result. But also, at the same time, it's a clear, strong commitment to reform. I think there'll be arguments whether that was the best way of doing such reforms or not. It was certainly amazingly well executed in one sense, insofar as nobody knew about it, and it took everyone by surprise, which was a good thing. Of course, amazingly badly for exactly the same reasons that it took everyone surprise and has caused confusion. But I think it's an important signal, and as a signal, will be read very positively from overseas. Longer term, although of course everyone's still looking for more and more reforms in India, and certainly as long-term followers of India, we know these things are not easy. They take time. The value-added taxes, for example, has been a long time in coming. Sort of free trade across movement of goods across state borders. It's all slow. That's the way India works, and this was certainly dramatic, and shows that the government is prepared to do things. It'd be nice to see some more things coming through.
Okay, that's good to hear. Hugh, what about the GST and the impact? How are you going to play that theme in India?
Well, again, for us, we're not going to play the theme itself, but for us, GST or value-added tax, for us is a long-term positive for the country as a whole, I think, if it's properly done. So it's not so much playing that specific theme, but more giving us confidence that India is making the reforms necessary to have a better, hopefully more fair economy as a whole, which is going to be good for all the things that we do in India.
Okay. One sector that has done exceptionally well this year is the metal space, the commodity space, but not too many people have really caught that rally. Would you be looking at any of the commodity stocks in the Indian markets at least?
No, we don't have any exposure, and it's probably too cyclical for us. I mean, I understand why it's had a rally, and indeed we've seen very strong rallies in similar stocks worldwide, in large part because they were so beaten down in previous years. So it's been very much a relief rally, but whether that continues or not is very debatable, I think. And certainly from a point of view of quality that we're looking for and long-term visibility, it's not a sector that immediately attracts us.
Finally, Hugh, how much are you in cash, especially in India funds? I mean, I'm trying to gauge how much do you anticipate things can fall so that you buy cheap?
That's good. I mean, in our own dedicated India funds, and we run 3 or 4 closed end. We run the India fund, for example, listed in New York, and a fund, Aberdeen New India, listed in London. Typically, we don't run big cash levels because they are there to invest in India. So we're not taking that decision within the portfolio itself, and typically run just residual cash of a few percent. So in our dedicated India funds, the answer is we don't have that much cash free to add, 1 or 2% typically. Of course, we can have cash flows coming into those funds if people get enthusiastic about India, or vice versa, cash coming out. But we also have large emerging market funds of 20-30 billion US dollars worth of emerging market funds that can alter their exposure to India. So that would be the likely source if we were positive or indeed negative on India. That would be from asset allocation within our emerging market or Asia Pacific portfolios.
All right, we'll leave it at that. Hugh Young, thank you very much for sparing time for us.